Hello, it's Dave here, and welcome to this part of the introductory section of our course. For this video, I'm going to be talking about spreads and pips. So, what do those terms mean? You might have heard it thrown around in Forex trading, but today I will just tell you how they work. So, let's get cracking. So, spreads are the difference between the buy and the sell prices, also known as ask and bid prices. Um, so as you can see here on this diagram, you've got the ask price or the buy price in the blue and the sell price or the bid price in the red. And there's a difference between them. In this case, it's 0.0001. So 1.2873, 1.2872 for the red one. And that difference in price is how the broker that you trade with actually makes money. So the reason for that is because when you buy a position, you're buying it at the ask price, and when you sell a position, you're selling it at the bid price. So that means that this difference is taken, or the value of that difference is taken by the broker. That's how they make money on Forex trading. So spreads do change. They change all the time, and they change with liquidity as well. So what you'll find is that more liquid markets, so markets with more money in them, so like the major Forex pairs like pound US dollar, euro pound, will have a smaller spread than the minor Forex pairs that have less money in the market. So things like New Zealand dollar and Canadian dollar pairs, ones that are not so common. So the important thing is that if you can find a broker with lower spreads, you get more profit. The one that we use is very low for spreads, and that's why we use it. You can see that on the Our Broker page of the website. There are other brokers which have similar spreads as well, and some which have higher spreads. So that's one thing to be aware of if you're looking at brokers. So if I briefly explain what's going on in this picture here, what you can see is the price changing over time with the spread staying the same. Now, let's say we buy this market at 1.2873 at this price. So we're on the blue line. The market moves up to this point. So we've gone up to 1.2874 basically, um, and we close out the position here. Now, if we close out here, we're closing out at the sell price. You have to sell your position, right? So actually, you're selling here because of the spread. And what that means is because this is equal to the price you came in at, you break even on this trade, or you would, and you make no profit. If you waited out longer until this point here, then now your price is at 2876. The sell price is 2875. So we'd be closing out at this 2875 price. And therefore you get these 2 points profit here in the gray. So that's how the spread affects your position and how much money you take as profit. I'm just going to show you a couple of examples on the chart. So here is a Bitcoin chart, the live Bitcoin chart, in fact, on an hourly. And you can see that I've got on the price on the chart here the buy price, and I've got the sell price. So if you observe the cryptocurrencies in particular, they have very large spreads. So you can see, look, this spread is 9338 minus 9269, which is about 68 in terms of the value, which is quite a lot. So you can see in terms of candles as well, it's relatively large compared to the hourly candles. The reason for this is because Bitcoin is very volatile, so that plays into it as well as the liquidity. so it moves up and down a lot, which means they put a bigger spread on it. So if we look at a minor forex pair, GBP AUD or AUD USD, yeah, so you can see on GBP AUD that the spread is smaller than Bitcoin. So we're looking at 1.80385 compared to 1.80219, and we're on an hourly chart again. So you've got 0.0017 roughly. Now looking at Forex, so you're going to have these 4 decimal places. Go into that in a minute. But yeah, again, you can see the bid price and the ask price. And then if we compare that to euro pound here, you can see it's not that obvious in terms of visually, but if we look at comparing the decimal places, then the bid and ask for Euro GBP, you've got 9035 and 9028 essentially, which is a difference of only 0.0008 pretty much. Yeah. So that's half of the spread basically of GBP AUD, and this because Euro GBP is a major forex pair. So that's a bit about the spread. Now, hopefully that all made sense. Now let's talk about pips. So pip stands for percentage in point, and it's literally just a unit of measure for forex. It just helps people to understand price movements when we're looking at things with decimal places. So it just helps to compare profit and price movements essentially. So it's the smallest price move possible on that forex market. In the case of main forex pairs, you've got 4 decimal places, and in the case of JPY pairs, so yen pairs, Japanese yen, you've only got 2 decimal places. So it's the 1 pip is the last decimal place here. So the 4th decimal place for euro US dollar, and the 2nd decimal place for yen pairs, like US dollar, Japanese yen. So that's 1 pip. Then if you go to here, you'd have 10 pips and 100 pips, 1,000 pips. You get the picture. So for example, 1.1000 to 1.1400 is 400 pip movement. So you can use that to just literally compare with a number that's a bit easier to understand than 1.1 blah and 1.14. That's literally all that pips are. It's just a way of comparing price in a easier to understand and visually pleasing format. So when you're hearing pips and this stuff, a lot of people like to talk about pips made and stuff like that. It's literally just saying how far the price has moved. You don't really have to worry about it that much because you can just use the numbers themselves. And I like to think of things in terms of percentages and risk to reward, which we'll go through in the risk management section, rather than using pips, because this pip difference doesn't tell you your risk or anything about the risk that you took for that particular trade. And that's it. So for this course, you've learned spread is the difference between the buy and sell, or the bid and ask, and a pip is just a unit of measure for forex trading. And that comes to the end of this lesson. Hope you've understood, and enjoy the next section of the course.